Oil, meanwhile, is back above $100 US a barrel, climbing after Tehran ruled out direct talks with Washington to help resolve the Middle East conflict. Now, the rebound follows Monday's sharp sell-off. So what does this mean for the broader market? Let's get some perspective now from Scott Chronert, head of U.S. equity strategy at Citi. It's good to have you join us. Good morning.
Hi, Lindsay. Good seeing you.
So markets, they were broadening out earlier this year. You've made note of that. How is the war in Iran really kind of weighing on your outlook now?
Well, the broadening argument really was a function of sort of a Goldilocks economic backdrop where you have soft landing economic conditions and an easier Fed. And that what was intended to promote, I think, a broadening in terms of earnings growth across different sectors and even down into U.S. small mid cap. What's happened with the backup in oil prices as a function of the Iran conflict is that you've begun to bring into question some of the premise for that broadening playbook.
We've been looking throughout the last couple of days and weeks in terms of how this price of oil is really going to affect basically everything. When it comes to the next earnings season, how do you think the price of oil will affect things there?
Well, the way we think it plays out here is over the next month or so, we have to continue to work through the Iran conflict itself, and we're watching the oil futures curve pretty closely on this. But what we think happens as we go into the Q1 reporting period is that we'll probably get another set of solid earnings results, much like we saw with Q4 reports. But the difference this time is we would expect that most corporates will be a little bit cautionary in terms of their outlook as a function of the uncertainty that's kind of unfolding on the backs of the Iran conflict and higher oil prices.
And you talk about that uncertainty, like now we're seeing, as we mentioned in the lead into Tehran denying that it's had any talks with the U.S., despite Donald Trump saying that talks have been happening between the U.S. and Iran. Like, is that an added layer of uncertainty for investors, or does it really come down to prices?
Well, I think as we've been going through this for the past almost 4 weeks now, I mean, the news flow, obviously in and of itself, is fairly uncertain, if you will. But I think what we're really focused on here is duration of conflict, and then therefore the duration of the spike in oil prices and the degree to which oil prices remain higher for longer and then relative to previous expectations. And it's that relative to previous expectations that really matters. So we expect that we're going to go back and forth. It's very hard to predict the actual timing on this. And I think most investors are in that same camp. So where we're focused on is my point here is that, we went into this year looking for an oil price deck, probably on WTI, in the mid 60s. And now we're looking at a futures curve that takes it in roughly $10 higher. So what that does is begin to feed through sort of the inflation mechanism, the product pricing mechanism, and we think ends up having, sort of an overhang issue on an otherwise fairly healthy consumption picture.
There are other factors, though, that you've highlighted apart from the Iran conflict that might be affecting markets, that might be affecting earnings season when it comes around again. So you mentioned private credit uncertainty, AI disruption, and funding concerns. Are any of those three a standout to you, or do you want to go through all of them and how they might affect things going forward?
It's a long list, right? Yeah. So I'd say the Iran conflict and oil is most topical right now. We kind of argue that has almost sort of a black swan potential there if this does persist for much longer. The private credit issue is more of a tail risk that we think is more or less contained, but we do need to factor it into our outlook. And then the AI disruption narrative, which was front and center just a month or so ago, is still out there, but that's a longer term issue. So we go back and forth on the AI playbook in terms of a productivity positive relative to a disruptive negative, and that's going to play out, I think, with different puts and takes. The tariff discussion is still in the background. That is less resolved as the Supreme Court overruled some of the IEEPA tariffs. So what my point here is that we've got a series of issues that have not really been resolved, and we expect that as we go through this next 1 to 3 month time frame, we should begin to get a little bit more comfort that we have a better line of sight to how those unfold. So in the meantime, the high level takeaway here is that expect uncertainty to prevail. We think it manifests in the Q1 reporting period. and it kind of keeps us a bit more focused on the risk elements of U.S. equities right now relative to the reward that we might see coming out the other side of some of these.
With that in mind, are there any sectors that you think could still outperform through all of this, or sectors that maybe investors in the meantime, as you say, like could go to as almost a safe haven?
Yeah, we've been arguing the U.S. as a relative safe haven versus rest of the world. And then within that, it's the mega cap growth tech cohort that we think is sort of arm's length from certainly the oil price issue. The fundamentals here, I think, are fairly visible around the AI build-out storyline, and we've seen that in terms of the earnings revisions, particularly on the semiconductor space. And in the case of software, which got a lot of negative press earlier this year, we think that's been finding bottom with a lot of the terminal multiple issue now priced in. So where we're going with this is U.S. We think is set up better than rest of world right now. And then within that, it's this mega cap growth tech component of the market that we think can be a little bit more of a relative safe haven as we navigate some of the more apparent macro concerns right now. And
just lastly, like I take your point on the mega caps, but what are your thoughts on small caps compared to maybe larger caps?
Yeah, so the small caps were an important call for us going into this year and as part of this broadening playbook. But again, that's where we were fairly reliant on this soft landing, easier Fed scenario, which is now coming into question as 10-year yields back up. The line of sight towards future Fed eases is a bit more complicated right now. And then, the economic sensitivity of small cap is always sort of a given here. And so it sort of is the poster child for where you would expect to see a lot of the negative macro influences of the oil price read through related tariffs and other factors come to play. So we're essentially stepping to the sidelines on that small mid cap broadening call for now, hoping to revisit in the next couple of months.
Okay, we'll leave it there. Scott Chronert, head of the U.S. equity strategy at Citi. Appreciate your time. Thanks so much.